Today, we're jumping into the story of a cryptocurrency that promised to build a whole new future for Web3, but instead it delivered a complete and utter collapse. So what on earth went wrong with LGNS? Was this a huge bargain, a hidden trap, or maybe a warning for the entire market? All right, let's get right into it. Just look at this number. This is our crime scene, a 93.2% loss from its all-time high. I mean, that's a number so huge, it's almost hard to wrap your head around. Let's put some real dollars to that to see what it actually looks like. From a peak of over $84 back in April 2024, crashing all the way down to around $5.70 today. How does an asset with so much excitement and so much hype just vanish into thin air? That's really the big question we're trying to answer here. Because, this isn't just about one token. This is really about something much bigger. What actually happens when a beautiful story about a revolutionary asset slams headfirst into cold, hard reality? So here's how we're going to piece this whole thing together. First, we'll look at the timeline of the collapse itself. Then, we'll rewind and hear the official story they were selling to investors. After that, we'll dig into the serious red flags that investigators started finding, use a professional's framework to tell what's real from what's not, and we'll wrap it all up with a practical survival guide for any trader out there. All right, let's kick things off with part one, the 90% collapse. To really get what went wrong, we've got to see just how fast it all unraveled. It all started with this moment of peak enthusiasm in April 2024, when it shot past $84. But, fast forward to July of 2025, and the whole narrative had flipped. Bearish warnings were everywhere as the price tanked to about $10. And today, well, it's just scraping the bottom, near its all-time low. A quick, thrilling ride up, and a very long, very painful fall back down. So how did we even get here? Let's hit rewind and look at the official story. What was this DeFi 3.0 dream that got so many people excited in the first place? Well, the pitch was that Salute Origin was going to be this massive, integrated Web3 ecosystem for, everything. Gaming, entertainment, you name it. The big idea was to build a decentralized world where creators and users could all work together and, more importantly, share in the profits. And the LGNS token, that was supposed to be the fuel for this whole engine. It wasn't just some coin to trade. It was for paying for things in-game, for minting NFTs, for having a vote in how the whole ecosystem was run, and even for earning rewards by staking. I mean, on paper, it really did sound like a super valuable, deeply useful asset. But that was the official story. Now let's switch gears, put on our investigator's hat, and start looking for the cracks in that shiny foundation. So, on the one hand, you have the super bullish case, right? The analysis that said LGNS was this comprehensive asset tying everything together. User actions, value, governance. It was pitched as the very heart of a new digital economy. And then you have the exact opposite take. Investigators like Danny DeHeck were not buying it at all. In fact, he called the project a ticking Ponzi bomb. So which is it? A revolutionary new asset or a really dangerous trap? So where does a heavy accusation like Ponzi even come from? Well, when you start looking at the red flags, a pretty troubling pattern emerges. The business model seems to be all about recruitment, not selling an actual product. And crucial financial data, totally hidden from the public. These just aren't the signs of a healthy tech project. They're the classic red flags of a potential pyramid scheme. This huge conflict between the story and the red flags can be pretty confusing. So how do we cut through all that noise? Let's bring in a professional framework that can help us tell the difference between a real bargain and a trap that's just dressed up to look like one. This comes straight from the world of professional money managers. It's a simple but powerful 4-step checklist. Number 1, is it cheap? That's valuations. 2, is the actual business healthy? Those are your fundamental drivers. 3, is it making money and not taking on crazy risk? That's quality. And finally, 4, are the big long-term trends going to help it or hurt it? Those are the structural forces. This iceberg visual is the perfect way to think about this. Everything you see on the surface, the price, the charts, what people are saying online, that's just the tip. The real story, the bulk of what makes an asset what it is hidden underwater. To find real value, and more importantly, to avoid disasters, you have to look deeper at the fundamentals. So let's try to apply this framework to LGNS, and boom, we immediately hit a brick wall. On the left, you see the kind of metrics you need for a real analysis.
profits, debt, user growth. And on the right, the only data we can actually find for LGNS, its price, its volume, and how people feel about it. The most important information is just gone.
And that brings us to the most critical point of all. It is impossible to properly analyze LGNS with a professional framework. The data you need to answer those basic questions about its health or its quality just doesn't exist. And when that's the case, investors are totally flying blind, left with nothing to go on but price charts and emotion.
Which leads us perfectly into our final section. Given that this is the reality sometimes, how do you actually protect yourself? Welcome to the Trader's Survival Guide.
Let's start with why this is so dang important. The numbers here are pretty grim. A shocking 87% of retail traders never manage to become profitable. And this isn't about being smart or dumb. It almost always comes down to a lack of discipline. The market is a battlefield, and most people just show up completely unprepared.
According to market psychologists, this massive failure rate usually boils down to 3 deadly discipline traps. First, there's gambler's ruin. You get obsessed with being right on every trade, instead of focusing on whether your wins are bigger than your losses. Second, revenge trading. You take a loss and immediately jump back in with a bigger, riskier trade to get your money back. And third, overconfidence. You start seeing patterns in what is basically just random noise. Do any of those sound a little too familiar?
So how do you fight back against your own worst instincts? You build a system. Think of it as your trader's constitution, a set of rules you never, ever break. This isn't about picking winners. This is about pure survival. By setting hard limits on your losses, you protect your money. By enforcing a strict risk-to-reward ratio, you make sure your winners more than pay for your losers. And by forcing yourself to take a timeout after a big loss, you stop emotion from wrecking your account. This isn't a suggestion. This is your armor.
And that really brings us to the final, most important question you should be asking yourself. When you see an asset that's down 90%, what is your very first instinct? Is it an emotional reaction, fear, or maybe greed? Or do you have a process to figure out the truth? The answer to that question could truly make all the difference.